Ladies and gentlemen, good day and welcome to Thomas Cook India Limited Q2 FY26 post-results earnings conference call, hosted by B&K Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone telephone. Please note that this conference is being recorded. I now hand the conference over to Ms. Purvi Zawar from B&K Securities. Thank you, and over to you, ma'am.
Thank you, Trisha. Good morning, everyone, and thank you for joining us on Thomas Cook India Limited 2Q FY26 earnings conference call. From the company, we have with us Mr. Mahesh Iyer, Managing Director and CEO, and the senior management team. We would like to begin the call with brief opening remarks from the management, following which we will have the forum open for an interactive Q&A session. I would now like to invite Mr. Mahesh Iyer to make the initial remarks. Thank you, and over to you, sir.
Thank you, Purvi. Good morning, everyone, and thank you for joining us as we discuss the Q2 FY26 financial and operating performance. Before I begin, I would like to introduce my management team who is joining with me on the call today. I have with me in the room Vishal Suri, Managing Director and CEO of SOTC Travel Limited, K.S. Ramakrishnan, Managing Director, DEI, Vikram Lalwani, Managing Director, Sterling Holiday Resorts Limited, Debashish Nandi, Group CFO and President, Thomas Cook India Group, Brijesh Modi, CFO at Thomas Cook India Limited, Bhavik Bhimani, who is the Financial Controller, and Urvashi Bhutani, who heads Investor Relationships. Before we go deeper into discussing the results of the quarter, I would like to highlight the key factors impacting our broader performance. The year so far has been a challenging one in the post-pandemic landscape, and Q2 continued to reflect this reality. Geopolitical flashpoints such as Operation Sindoor, rising lion, the global trade war, and the escalations around H-1B visas, as well as the evolving political situation in Nepal, have all continued to shape global and regional risk sentiment. During the quarter, the trajectory of our recovery was impacted by weather disruptions across North India. This had a pronounced effect on our domestic travel business and the leisure hospitality segment. That said, despite these external pressures, the resilience and breadth of our portfolio enabled us to maintain stability in our performance, demonstrating our ability to navigate volatility. Revenue from our operations stood at 20,738 million, up 3% YOY. For H1, we were at 44,818 million, a growth of 9%. Profit before tax after exceptional items maintained at 2,211 million in H1 FY26 versus 2,187 million in H1 FY25 and 1,098 million in Q2 FY26 versus 1,096 million in Q2 FY25. I would like to highlight here the one-time exceptional item that we had in the books this quarter, which may not repeat itself going forward. I'd like to additionally place some highlights that underscore our momentum and our strategic progress beyond the operating environment. This quarter, we had some encouraging recognitions and innovations. Thomas Cook India Limited became the only Indian company to win 2 honors at the prestigious Adam Smith Awards 2025. We were recognized for the Best Risk Management Solution and Best Investing Solution, which really speaks to the strength and sophistication of our treasury management practices. In addition to this, we were also honored at the India Travel Awards 2025, reaffirming the trust and leadership of our brand and the brand equity that we enjoy in the industry. On the innovation front, in Forex, we have taken some major step forward in terms of customer convenience. As a leader in the foreign exchange business, we have always been at the forefront of innovation, be it product, tech, or being the first brand to sell Forex online. Now I am thrilled to share that Thomas Cook Forex is the first and the only Forex provider to partner with India's largest quick commerce platform, Blinkit, to deliver Forex cards for travelers and students in 10 minutes. All through this, The customer does not need any physical documentation or have to leave his home, both of which were pain points in the traditional forex purchase flow. And I will elaborate a little more on this in the later part of my conversation. We also launched TCPay, our new integrated mobile app that gives customer a simple one-stop digital solution for managing all their forex needs on both Android and Apple devices. And further, to strengthen our payments ecosystem, we enabled contactless cross-border payments through Google Pay in partnership with Visa and MasterCard. This enhancement makes our borderless prepaid card and the Study Buddy Forex card even more convenient for international travelers and students. On the travel front, we made progress on our AI initiative, which is the agentic assisted model called DESI, which will now be at the forefront of our selling initiatives, and together both will enable a better customer experience. I'll now move on to some of the segmental performance highlights. To begin with, on the financial services, to better understand our performance, I'd like to share a few statistics based on the RBI LRS data from January to August 2025. In the addressable segment of travel and education and maintenance of close relative, the LRS data show a year-on-year decline of 5%. In comparison, Thomas Cook India's corresponding YTD volumes remained flat. This demonstrates the strength of our product offering, our operational excellence, reach, and distribution network. Our FX segment revenue for Q2 FY26 stood at 845 million, marginally higher than the 839 million in Q2 FY25, an increase of 1% YOY. This limited expansion was driven by softer demand in specific subsegment, particularly education-related forex. If we look at the LRS data for July and August compared to the same period last year, the degrowth is around 15%. And conversely, if you compare our performance, we actually grew marginally. Having said that, we have actually increased our turnover in the retail segment by 13%. This was led by a 13% increase in the holiday sale, and our education segment increased by 9% YOY. The performance of our airport segment is actually not comparable, which is included in this, which show a sharp decline because we are no longer present at the Delhi airport. As you will recall, we exited the Delhi airport in May 2025. More importantly, our EBIT for the quarter stood at 411 million, broadly in line with the 410 million that we delivered last year. EBIT margins remain steady and healthy at 49%, reflecting strong operational discipline and efficient cost management. In terms of our digital adoption, we were at the 22% mark. Our WhatsApp engagement continued to see an upward trend and grew by an impressive 108%, albeit on a smaller base. Our app bookings were also up 25%. These reaffirm our efforts to enhance digital engagement and ability to meet our customers' needs where they are. As we move into the second half of the year, our priorities remain clear to deepen digital adoption and improve customer experience. And with that in mind, we continue to expand digital initiatives to new levels. We launched TCPay, an all-in-one forex app designed for the first mobile traveler, as I mentioned earlier. We are also proud to be the first forex card provider in India to enable contactless cross-border payments achieved through our partnership with Google and Visa. This milestone reflects our focus on delivering frictionless global payment solutions to our customers. And of course, our first of its kind service in India by partnering with Blinkit to deliver forex cards right to the customer's doorstep within minutes. This unique initiative places customer convenience at the forefront and further strengthens our Ghar Pe Forex promise. This service is already live in Delhi, Mumbai and Bangalore, backed by Blinkit's rapid last mile network with a phased pan-India rollout planned in the coming months. In October, we have already added Hyderabad, Pune and Chennai to the list. Moving on to the travel and travel-related services segment, for the second quarter of FY2026, travel segment revenue stood at 16,891 million, representing a 6% increase YOY over the 15,915 million in Q2 FY25. This quarter was a mixed bag on the travel front. The global travel landscape continued to navigate a period of uncertainty marked by shifting geopolitical dynamics and domestic reasons, which I alluded to in the beginning. If you compare our H1 numbers, our top line improved by 12% YOY to 36,675 million. Now, had this quarter been devoid of few of the external factors, we would have been closer to the 15% mark that we have been targeting. Let me give you a deeper insight into some of the segments as we present them in the form of B2B and B2C. On the B2B businesses, which contribute 75% of our total segment revenue, increased by 12% overall. The destination management business, which includes India and our overseas operations, reported a 5% increase during the quarter. This growth came despite a 10% YOY decline in the India DMS business, which caters to India, Nepal, and Sri Lanka. The India piece was impacted by temporary headwinds, including protests in Nepal and softer demand from some of our key source markets, partially due to the travel advisories linked to the India-Pakistan border conflict. On the international front, our overseas sales grew by a healthy 16% YOY. However, this growth came with a shift in business mix as some of our high-volume regions contributed at a slightly lower margins given the conditions and the uncertainty in key destinations. Traditionally, Southeast Asia and USA are amongst the strongest regions during this quarter. This year, however, performance across these markets was mixed and lower than actual potential. In the US, which is usually a strong quarter, was affected by a softening in travel sentiments and weaker bookings, largely due to the ongoing geopolitical uncertainty. This led to more cautious travel behavior and muted inbound traffic in the US market. In contrast, the Southeast Asia continued to perform steadily, supported by consistent inbound volumes and the overall resilience of our regional travel demand. That said, broader geopolitical spillovers did limit the region's full growth potential, particularly in some long-haul markets. Additionally, the share of higher volume business came at a slightly lower margin, which impacted our EBIT contribution during the quarter. Moving on to the MICE business, the segment improved marginally in this quarter, mainly alluding to the same reasons of weather adversities and the global travel being limited. Several corporates had delayed their MICE-related events. While July and August were muted, we saw the trend reverse from September onwards. It's important to highlight that the changes introduced under GST 2.0 will translate into higher sale across various categories that we have witnessed in September and October, more specifically the paint, the automobile, cement, insurance, etc., which are large consumers in this segment. Our belief is that the broader impact of the changes coming from the GST will result in much more visible performance in the next 2 quarters. Corporate travel, the segment reported strong growth in Q2 FY26 with revenue rising 27% YOY from the 317 million in Q2 FY25 to 402 million. Air revenue saw a growth of 4%, whereas non-air transactions expanded by 20%. Hotel and car bookings saw a healthy traction, increasing 23% and 9% respectively. The company strengthened its corporate presence by adding 11 new accounts across diverse sectors and improving adoption of its self-booking tool that stands today at 59%. A key focus area was digitalization through platforms like Travel One and Dhruv AI, which introduced an AI-powered corporate booking tool. Coming to our B2C portion of the business, which account for 25% of the travel segment, leisure holiday segment posted a steady growth. In Q2 FY26, the segment delivered a 7% YOY growth, rising from 4018 million to 4310 million. Outbound holidays continued their strong momentum, though at a slower pace with a 7% increase. Domestic holidays recorded a 12% rise in Q2 FY26, despite the disruptions that we saw in Q1 and Q2. This does not reflect the full potential that we anticipated. The segment's performance was constrained as domestic travel was impacted by excessive rainfall and landslides across northern India, leading to limited demand. In terms of some of the initiatives on the leisure side, while we have mentioned these in our communication, I'd like to call out some of the important ones. We launched an expanded China holiday portfolio. This leverages the resumed direct air connectivity and rising travel demand and is aimed at new destinations alongside classics such as Shanghai and Beijing. We are curating group tours and customized itinerary for leisure, business and MICE travelers. We also restarted the Kailash Mansarovar Yatra for the first time since COVID 2019. We also introduced special regional tours during festive like Durga Puja, Dussehra, Diwali, both on the domestic and the outbound side. Now, when I look at the overall EBIT for the segment, it was lower by 16% in the quarter to 651 million with a margin of 4%. While we have been able to improve our top line, the margin has been lower than our expectation. During the quarter, given the tepid demand scenario, there were extra efforts towards marketing and sales initiatives. The numbers also reflect the impact on sub cancellations that came in some of our businesses. Competitive pricing pressures and lower than expected performance in some of our key growth markets for the quarter added to this decline in our EBIT margins. To add a little color on the outlook for the leisure segment, we started the quarter at a relatively slower pace, but through July and August, however, the segment saw a noticeable pickup from September onwards. As conditions improved and travel demand began normalizing, helping holidays regain momentum. In the upcoming quarters, we expect higher activity on both B2C and B2B segments. India's consumption engine is poised for a powerful revival in the second half, supported by tax rate cuts and GST rationalization, which will help drive discretionary income. With this, I would like to hand over to Vikram, who will take you through the performance on the leisure hospitality side. Over to you, Vikram.
Thanks, Mahesh. Good morning, ladies and gentlemen. My name is Vikram Lalwani. I'm the Managing Director and CEO of Sterling Holiday Resorts Limited. I'm also joined by Mr. L. Krishna Kumar, who is the Chief Financial Officer for Sterling. Thank you for joining us as we present the results for H1 FY26 as well as for the second quarter. Despite quarter two being a traditionally lean quarter for leisure hospitality due to seasonality factors and the headwinds faced, I'm happy to inform that Sterling has yet delivered its 23rd consecutive profitable quarter. In line with our transformative thrust on resort business, we have recorded a growth in resort revenue in Q2 of 13% and a RevPAR growth of 11% year-on-year, against a backdrop primarily of a 28% YOY expansion in the resort portfolio, with a milestone record of having launched 7 resorts in Q2 FY26. Sterling's financial position remains strong. Our cash reserves grew 51% year-on-year by another milestone of 1,000 million to 3,080 million so far, and we remain completely a debt-free company. This reflects the robust cash generation and as well as reserves in our books, while we are simultaneously also investing for future growth. H1 FY26 was marked by a record Q1, but with temporary headwind impact that impacted Q2. Sterling delivered a stable performance with a revenue of 2,400 million approximately versus 2,450 million of last year, and an EBIT margin of 24.1% compared to 25.6% of last year in H1. The standalone EBITDA remained healthy and consistent at 32% for H1. Q2 was impacted primarily due to severe weather headwinds affecting almost 40% of our rooms, coupled with the sunsetting of membership acquisition in Q2 of last year. The associated fixed costs of the impacted rooms and the ramp-up costs of the new rooms impacted EBIT margins to a small extent. As a result, the revenue stood at 1,044 million with an EBIT margin of 16% for Q2. These are temporary effects, and the underlying demand fundamentals still remain strong, as envisaged with a record Q1 and of strong forward booking positions for H2. Sterling's portfolio now has expanded to 56 destinations and 66 resorts, hotels and retreats with over 3,400 rooms. Our pipeline continues to grow with an expected number of 10 resort destinations in H2 and another 15 in the quarters to follow, totaling an approximately of over 4,500 rooms and over. Our expansion continues to be on an asset-right, capital-light model. A recent accredited industry survey of hospitality companies now ranks Sterling as 9th, up by 1 rank over last year on the number of locations, 12th, up by 2 points over last year on the number of properties, and 16th, up 3 on the number of rooms. Guest satisfaction continues to be a defining strength of the Sterling brand. Our TripAdvisor ratings improved to 4.61 from 4.57 of last year, a testament to the exceptional experiences consistently delivered by our resort teams. In Q2, Sterling Lake Palace Alapi in Kerala was awarded the Best Resort Spa by Hospitality Horizon at their Spa and Wellness Summit Awards. In Q2, we've also done a lot on the asset management side, which I will take a minute to explain that as well. On this asset management side, we used Q2 to focus on capacity expansion by sweating incrementally our own assets where possible and product enhancements in some of our key resort portfolios with an intent of building immediate future additional revenue streams. Sterling Puri is being expanded with 46 new suites, up from current 121 rooms and suites, with revenue contribution expected from Q3 FY26 and having its full impact from Q4 in FY26. And this is our own asset as well. We have completed expansion of Sterling Kodai Valley by another 32 suites from an existing 120 rooms and suites, which will have its full impact from H2 onwards. Sterling Kodai Lake, Sterling Nainital and Yerkad completed incremental plan upgradations in Q2 with impacts expected from Q3 FY26 onwards and hence in H2. Sterling Munnar is, we are also upgrading 51 rooms there. That's about 38% of the total inventory, on track for a mid-December completion before the peak holiday season, and its expected impacts in December last week and a full impact from Q4 FY26 onwards. Under Sterling Sankalp, our ESG initiative, we have completed investments and deployments of heat pumps across our key resorts, including Kodai Valley, Yerkad, Ooty Elkil, Kodai Lake, Mussoorie, Darjeeling, and Puri. This initiative is expected to reduce energy consumption by approximately 350,000 kilowatt-hour annually, while minimizing water wastage, reinforcing our commitment to sustainable and responsible tourism. These will also start showing its impact on cost efficiencies going forward. With weather conditions behind us, weather headwinds behind us, rather, I beg your pardon, and a 30% increase in Saya dates, with 14 of our jungle resorts having reopened, and new revenue streams from recently opened resorts in Q2 and H1, and contribution from our new resorts and upgraded rooms, our business is well positioned for a renewed growth momentum and a successful closure of FY26, consistent with the performance of the previous years and previous other 22 quarters. Thank you so much.
Ram, you want to come in, please?
Yeah, hi. Good morning. This is K.S. Ramakrishnan, MD and CEO of DEI. A warm welcome to all you ladies and gentlemen. Quickly to tell you a bit about our quarter. The quarter 2 financial year 26 ended up at 1,958 million as against quarter 2 of 2025, which was 2,088 million. Slight of flattish quarter, whilst historically this has been our lowest quarter from a functional revenue perspective. The EBIT drop has been from 65 million last year to 23 million this year on the same quarter-on-quarter. Half yearly, from 4,162 million that we did in H1 25, we've done 4,055 million in H1 26. EBIT during the same time for the H1 has been fairly flat at 131 million in half year 25 as against 129 million this year in half year H1 26. Predominantly the key pointers that explain the drop of the top line would be UAE contributes to nearly 50% of the market share of the market that we do. And Q2 has been traditionally a low quarter due to both the peak summer and also this was also burdened further this time with the geopolitical factors. Travel into UAE has seen a dip of about 15% across the board. Over and above this, Malaysia and Singapore added to the woe for us with some unplanned closures of a key venue, which is more periodic, and it won't be repeated again. Resorts World Sentosa Aquarium in Singapore and the KL Tower in Malaysia were closed for either upgrade or for some other political issues that happened in Malaysia, but all of those have been resolved and they're back in action. More than 80% of our locations have gone live with our new solution VC. There has been a double cost of running this VC through, and that has added to hurting our EBITDA. As a norm, 80% of our sites are now on VC. More than 1,500 operators have started operating this across the globe. There's the expected tweaks and trainings that are being made as we go along to ensure that the peak period is maximized, and we are parallelly running this along with our existing software. So these two things have also added to our cost structures. On the brighter side of the horizon, we have large accounts that we have won during this quarter, which includes Ain Dubai, Ocean Park, Legoland Shanghai. All of these take about a quarter or two for stabilization, and we anticipate a huge uptake, a decent uptake at least, on our revenue performance in the coming subsequent quarters. We have, to add to all of this, the last quarter, or rather the third quarter for this year, is our key quarter, and the whole team has been fully prepared. We anticipate a fairly robust quarter this year as we go along. That's all from my side. Thank you very much.
Trisha, you can now open the floor for Q&A, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 1. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Anil Shah from Insightful Investments. Please go ahead.
Yeah, hi sir. Good afternoon to all. My question is on Sterling Holiday Resorts. You know, we have, compared to last year September 24 versus September 25, we had higher inventory rooms, obviously because the number of resorts and number of rooms that we had offer in September quarter of 24 versus 25, it's much higher in 25, almost 16% higher. We've talked about an ARR which is up 10% from 5,400 odd to about 5,900 rupees, and occupancy overall has remained constant at 49%. So if I look at your presentation last year in September 24, we talked about 49% occupancy then, and we now speak on 49% occupancy on the expanded inventory base. Yet our revenue has declined. So that's the first question. I'm just not able to fathom this. In the meanwhile, in your PPT, we've also mentioned that room revenues are up 22%, F&B is up 11%, management contract revenue is up 22%. But overall, Sterling Holiday has seen a decline in revenue on Q2 terms. So just not able to reconcile. That's the first question. The second question is that how EBIT has come down so substantially. Most of the weather conditions and the geopolitical, etc., actually hit utilizations or occupancy, if I may say, which is anyway constant. So, what are those kind of costs which, has hurt us primarily because of weather conditions and because of, whatever else that may be?
Okay, thanks. This is Vikram here. Let me just explain this again and in detail. The statement I had made was, that we had about 40% of our rooms impacted. even on an expanded base this year in quarter 2, because our hotels in Himachal, Uttarakhand, where we have a very strong presence, was in a large portion of the months, and any which ways, this being a lean season, was typically cut off from traffic. Mussoorie, Nainital, Corbett, Manali, Kufri, etc. Right? Now, these had, that's number one. Number two is, hence, even on an expanded base of 40% of our rooms were out. In fact, the growth that we got in the resort revenue actually also speaks about the resilience in sterling. It came about only with 50 to 60% of its remaining inventory. So imagine if, the fact of the matter is that we did not have these very strong headwinds. I think we would have been able to record a far higher and a steady, in fact, a far higher growth in the resort income, number one. Number two is the fact that, as we've been mentioning even in the past couple of quarters, we have been ramping down and we eventually sunset the membership business in Q2 of last year. So therefore, the revenues that we had from the membership income, including its subscription as a result, which was there until Q2 of last year, is not there this year. Now, having said that, we would have been able to substitute this this gap very easily had we been able to operate the remaining 40% of the rooms. So to that extent, the gap has been there in Q2, which should not be there from Q3 onwards, because then that will be a like-to-like comparison. So that is why there has been. Let me just finish. So
yeah, sure.
There has been a slight change in the revenue line. Now, on the cost line, when many of our resorts are typically closed out, we still incur fixed costs in those resorts. While I may not be able to move the guests in there, I still carry fixed costs without earning revenue there, like salaries, wages, maintenance, basic electricity, and these costs that we will have to carry. So that's number one. Number two is, even when we use this opportunity to ramp up another 7 resorts, which was a milestone we've ever done before, in the month of September, which impacted last portion of Q2, we actually leveraged a lot of the resources from these 40% of the rooms, into actually opening these new resorts. So it's a question of how we leverage the resources internally when we are not able to actually utilize them in their current destinations because of the fact that we are not able to move the customers. So this is a one-time, ramp-up cost also that tend to hit us, especially when we are, ramping up. Now, all the revenue streams should start coming in from H2 onwards, and it's already started. Having said that, despite the issue of headwinds with 40% inventory, as well as a one-time substitution that could not happen with the drop in the membership income because we curtailed it, the H1 has still remained stable because of the Q1 numbers being buoyant. And we are very confident that the H2 numbers will actually far surpass any kind of a negative trend that has happened in Q2. Having also said that, we've had 22 quarters of profitable growth. And this quarter of quarter 2, has been impacted with both these parameters, as well as the fact that we've taken, ramped up new inventory, as well as, upgraded our current resorts. We use this opportunity to do that to better our streams in H2. But still, our H1 actually still remains stable.
So, just to clarify, maybe my understanding is not correct out here. I repeat, when we say we have to take off 40% of the rooms, just not available, do we take them off the denominator when we talk about occupancy?
No, we don't take them off the denominator.
So then the occupancy, sir, if I may, is constant. In last year, September 24, your occupancy was 49%. It's 49% again on the denominator, okay, which is much larger. So in terms of number of actual rooms that are being used and, for which we have billed is higher. Is that correct?
That's fair. That's fair. And in fact, what
exactly the question then why is, and the only thing that so far that I can get an explanation from you is that members were lower compared to last year. So if you could quantify that number, because otherwise how could revenue be lower? I'm not still able to understand in terms of revenue. I can understand in terms of cost to some degree, not completely yet. But how revenue can be lower on Q2 versus last year's Q2?
So let me tell you now, when we're saying this 40% of the inventory, there are two kinds of inventories that we have, right? One inventory, and this is there across the board in the hospitality industry as well. One inventory is the inventory which is and impacts the P&L, which is known as own lease or revenue share inventory. And the second is a partnered inventory or a management contract inventory, all right? So while the occupancies might have gone up in a management contract, what the amounts that what will get reflected in our P&L is only a certain portion of that incremental, because we only get a commission income from there.
Correct.
So, what happens is, so even, whereas, out of the 40% that has gone, almost, 50% of that is our own lease and revenue share. So we had to carry those costs. And they're large hotels, like Mussoorie is a large hotel, Kufri is a large hotel, Manali is a large hotel, Nainital is a large hotel. So they were all reflecting in our P&L. So therefore, on the flip side, when we could manage to leverage the south and the east or the west, not necessarily everything is our own inventory as well, number one. Number two, yes, we did have a sale of approximately about 400 or 500 membership units last year, which eventually is not there this year, and the associated subscription amount of that. Now, if we've been able to leverage those on the impact of the own lease revenue share rooms, which were virtually shut down in Q2, including Jungle Resorts, this would have actually been easily substituted. Therefore, actually our growth in resorts would have actually been over 20-25%, which is the model that we are actually headed towards. That's the answer.
Fair. Thank you, sir. Thanks. I think, at least just to summarize, basically it was our own resorts where we get 100% of the revenues, okay, which was those 15 resorts. More of those were unfortunately not available for tourists because of weather conditions, and hence we got more hit in this Q2. Is that understanding correct? And the second part is obviously the fact that we had about 400 or 500 rooms booked by members in Q2 last year, for which we got revenue and we got subscription, which we did not get in this Q2 of this year.
Absolutely. And we would have been able to substitute that and actually grow further.
Right.
You're absolutely right. But having said that, even when we entered October, now we are in the middle of November,
right,
those headwinds are behind us now. Right?
Right.
And this is and since we sunset the membership story or in acquisition in Q2 of last year, so even when you compare Q3, that's not going to have an impact going forward.
Right. So, and last thing, sir, the startup or setup cost that you really have to go through initially. So we had seven new resorts which started. Obviously, they take time to ramp up, maybe, another couple of quarters. But in this quarter, when you start off these things, what would be an approximate cost per resort that you would have debited in your P&L in this particular quarter?
Okay, let me just answer that in two parts first. Now, whenever we open a hotel or a resort, while we have a particular date from when, the guests can come in and start booking the revenue, our cost typically kicks in at least about a month and a half or 2 months prior to the opening. So in a case like why? Because we have to put the manpower, we have to get the supplies, finish the product, etc. So actually our costs kick in. So there was a conscious call that we had taken that despite the quarter being a little tough one, we actually rather go ahead and launch or open new hotels. It takes that cost from July, August onwards when we open these hotels in September, because it will have a positive impact in H2. That's step number one.
Fair.
Step by step. Right. So the first, say 60 days prior to opening.
I think I'm sorry to break in, but there are other people who have queued up for questions. Can you give them a chance, please? Thank you.
Yeah, sure.
Yeah, sure, sir. Thank you, sir. Thank you so much.
Thank you. A request to all the participants, please restrict yourself to 2 questions only so that the management can answer to all the participants. Should you have a follow-up question, please rejoin the queue. The next question comes from the line of Deepak from Unify Capital. Please go ahead.
Hi, thanks for the opportunity. Vikram, first question is to you. So we understand that this was a tough quarter because of seasonality, but are we losing out to competition, or is there incremental supply of rooms coming in our existing geographies that could have impacted demand? That is one. And your comments on the cost built up that happened this quarter, if you can quantify that, and whether it will recur or not in the future. And with the H2, with regards to H2, if you can provide an outlook on revenue growth that you've seen in October and the forward bookings that you have, and the margins relating to the segment. Thanks.
Thanks, Deepak. There's a lot of questions. So let me try to answer one by one in a very short, abridged manner. I think the first question is on the expansion and demand supply on competition. Now, that's why I mentioned that, obviously, as and when we keep incrementally adding rooms, our revenue stream tends to go up. Now, we are present predominantly in leisure, where we think we have a far more competitive advantage when compared to anyone else. And we are also moving towards the Tier 2 corporate setup. For example, if we say in Bokaro, Madurai, Dehradun 2 hotels, Karwar, we are far ahead of competition in that sense. How we actually gauge that? Actually, we gauge it on the basis of, the kind of market share that we have through some of the online channels versus that of the others. So we're kind of ahead of competition on that front. And we are actually expanding into destinations also that are where we get the first mover advantage. Like Ayodhya, like, Malampura, etc. We get the first mover advantage there. That's answer to question number 1. The question number 2 was, sorry, what was that?
It was regarding the cost that we've incurred in upgrading the properties that might not recur going forward. So if you can quantify that. And the third question is on the outlook.
Yeah, on the asset management side, we always use this opportunity to sweat our own assets as well as constantly upgrade, because with the transformation of the business model that has happened, you have to continue to remain competitive, as was your first question. So our cost of a typical and incremental room is approximately 12 to 13 lakhs. And that is why we rather focus on expanding or sweating our existing assets so it has a stronger impact on the P&L going forward, which is what we've done. Number 2, yes, we will continue to expand even on an asset-light model. When I keep saying asset-light, it's a combination of asset-light and a little bit of revenue shares and leases. So we will continue to expand on an asset-light model to leverage the network strength that we bring in. So that's point number 2. On point number 3, if you see, H2 has actually opened much stronger. As I said, that the headwinds of especially the weather is far behind us. And most of these destinations have actually already started reopening, right from the Dussehra Diwali time. So I would say that H2 will be strong. The kind of growth that we are getting in the resort business, we could possibly hold those growths, and maybe with the incremental rooms, we could even add on new revenue streams in H2, which starts from Q3 onwards. So there's no, in fact, Q3 is looking good.
Sure. Got it. If you can just quantify the cost that we incurred, sir, in this quarter, and with the growth that you've spoken about, will the margins come back to the older levels that we
margins have been 32% in H1. And as you know that in the hotel industry, a good margin is between 30 and 35. Most of them tend to hold that. We will continue to hold those margins, for this entire year as well. There may be a slight blip as might have happened in Q2, but we are bound to rebound in Q3 onwards. So if you have to look at it from a full financial year perspective, we will continue to be between 32 to 35 for sure. Yes, we will also make some investments for the future because of the growth that we are driving in, but I'm confident that these margins will hold.
Thanks. So second question is to Mr. Ram. If you can give an explanation of the path to profitability in the digital imaging business, because we've had 4-5 quarters of low revenue growth and very low profitability. So from a revenue and cost lever standpoint, what are we seeing? The outlook for this segment. I mean, if you can explain how do we profitably improve in this segment going forward?
Yes, I'll take a jab at that. The last 4 quarters in a row, or last 5 quarters in a row, we start working on our new technology. This obviously comes at additional cost, whilst we are using our existing technology until the previous quarter. So these numbers on some of the cost segments will be bettered as we go along. But the profitability of this business has been fairly consistent for the past 20 years that this company has been, since we have been a profitable company consistently, and that ethos still follows. We've done a lot of corrections post-pandemic, which you see the results in 24 mid, when the technology started and we started producing it, the cost has gone up. In particular, the levers are basically getting efficiency of labor, and that will come in only by the technology getting fully implemented. And that, as I said, will run through this quarter and next quarter where we are implementing and running. So the organization is extremely confident of delivering a consistent profitability in this business over a period of time.
Okay. So can you guide us with any outlook for this? Because the growth doesn't seem to be coming through despite adding new geographies, upgrading in existing locations. So revenue growth has been a challenge, and the cost side, although I understand that you've migrated to the new tech, but you're saying that it will take some more time to reflect in the numbers. So if you can guide us
on the revenue.
Yeah.
So if you've been following our business for the last 2 years, we have shut down a lot of inefficient geographies and sites, which is done as a regular cleanup over a cycle of 3 to 5 years. Our business model is such that when you start operations, you have to give the first 6 to 12 months for it to come to peak. All right?
Right.
Sorry to interrupt, sir, but the Ram sir's line has been disconnected. Please hold on a second while we reconnect them.
Please ask the next guy who's in line to ask his question while you
Okay,
reconnect
sir.
round so that we don't wait long.
Okay, sir. Thank you. Our next question comes from the line of Naveen from iThought PMS. Please go ahead.
Hey, I hope you can hear me.
Yes, I can.
Yeah. First of all, congratulations on holding steady in a very tough quarter with respect to the macros. I have this one question regarding the Forex business.
Sorry, I just fell off.
Yeah.
I'm sorry.
Yeah.
Sorry,
Yeah.
go ahead, continue.
Just hold on, Ram. Somebody else is
No
asking a
problem.
question. Yeah.
No problem. Sorry.
Yeah. Okay. Regarding the Forex business. I just read some recent articles about banks offering zero Forex cards. I was just wondering if you guys have any thoughts on like the demand uptake for these zero Forex cards and essentially like any comparison and contrast from the Forex prepaid cards that we offer and whether it's targeting the same customer cohorts or how we should think about this. Just wanted to get some sense on that.
Naveen, I'll take that question. This is Mahesh here. Look, there are different kind of models to get to the market. To me, this is more like an entry strategy. But you would know that a zero markup, a zero currency exchange, these are not sustainable models. You will get what we call the GMV or the top line, but very difficult to make bottom line out of it. The market that we are focused is very segmented. We are focused on the holiday segment through our borderless prepaid card. We are focused on the student segment to the study buddy, which is focused on the education segment. And we have what we have for the corporate, which is called the enterprise card. So we are clearly segmented in our approach, and we are looking at those niches in the market where we can actually make meaningful dent. Just to give you a perspective, our current market share on the prepaid card side is anywhere between 31 to 32%, and we are growing. And I think at that scale that we operate, I think we've made our product relevant to the market. And my belief is that with the new innovations that we are bringing in the category, like the addition of Google Pay, where it's available for customers to seamlessly add to their wallet and then use overseas, and some more new developments that we are currently working on. I'm sorry, I'm not at liberty at this point to share some of the things that we are doing at the back end, but when we are ready, we will talk about some of those things. But I think clearly what I want to highlight here is that we are progressing right. We believe that from a market perspective, we are segmenting it well, and we want to grow in this space where we believe we have the moat to grow.
Got it. Yeah. Thanks a lot.
Thank you.
Thank you. The next question comes from the line of Soumya from Insightful Investments. Please go ahead.
Hi, sir. I had a question regarding the travel segment. Hello?
Right, Soumya.
Yes, please go ahead.
Yeah. So I was just wondering, other than the domestic DMS, which is overall a very small part of our aggregate travel revenue, we have shown that there has been growth across all other sub-segments. However, EBIT has not been able to grow. EBIT has in fact declined by 16%. If you could just explain that decline, that would be great.
Sure. Soumya, thank you for that question. And, I alluded to that in my opening comment. You're right. We saw some degrowth in some of the segments, but overall, the segment still grew. But please remember that when the external environment is not so great and not so conducive, you actually end up spending more to the market. And that's exactly what we did. The second element, obviously, the spends that I'm talking about are nature of marketing and distribution, and we had to spend a little more money to the market. The second is that on the overseas DMS businesses that we have, the mix of the business actually changed. So we actually got a little more of the low margin business as compared to the high margin business that we usually attract during this quarter, specifically in markets like US, which is the peak season for the US market is the July-September quarter, while we managed to hold some part of the top line because of our forward bookings, but the mix in the way the business came in impacted our margins. So to that extent, the margins got impacted or diluted.
Okay, sir. Thank you. That was all.
Thank you. A reminder to all the participants that you may press star and 1 to ask a question. The next question comes from the line of Deepak from Unifi Capital. Please go ahead.
Hi. Should we continue with Mr. Ram's comment on the Digi imaging business?
Yes. So you were talking about the revenue drop or the revenue flattish or growth. As I said, in the cycle between 3 to 5 years, we look at every account because it takes about a year for it to come to the optimization. So in the last 2 years, we have also shut down a lot of our non-profitable sites. In the meantime, we are also building up a new solution. When you build a new solution and implement it, it will be not a very fair thing to go and aggressively open new markets with a new software until it gets stabilized. And that's why these 2 quarters are very crucial for us. The 2 quarters are following which from the second quarter of next year, rather the first quarter of next financial year, is when you will see some revenue growth opportunities. Also, efficiency of labor and the digital channel will open completely, which will be one of the biggest reasons why we've invested in the technology. So a bit of patience from our end is very much required when we do this entire change. But there's very good optimism on the opportunity of growing this revenue, similar to the way we've been doing it for the past 15-20 years. This 1 year or 1.5 year of this transition is always something that we had consciously taken to do the change.
Ram, if I can just come in for a minute and add to what you just said, and Deepak, it's important to also look at the H1 numbers. If you look at the comparison, it's 131 million versus 129 million. This also shows that despite the fall in top line and to the reasons that Ram just mentioned, which is more like portfolio management that we do from time to time, our revenue is held still despite the fact that we were taking a double whammy on account of implementation and software costs. So I think it's all about building that scale and momentum. It's a bit of a patience in this that we are trying to do. And like any software implementation, and this is a large one going across multiple sites, it does take time. There are challenges that come across. My belief is that, as Ram rightly said, we are here for the long, and I believe this should start giving benefits in the long run.
Okay. So is it fair to assume that we would continue with this 13 crore first half number for second half as well and then improve going forward?
Deepak, it's not that way. This business also goes through the seasonality. Yeah. So there is a seasonal quarter, and I think Ram said it in his remark that Q3 is his biggest quarter. So you will see that impact coming in. But obviously Q4 gets back to the normal run rate. So it's not more like a straight line that we can put in there. But yes, Q3 could be comparable to Q3 that we had last year, and obviously Q4 will be comparable. We will see some benefits of the software coming to play, but too early to mention about it. Ram, you can add anything.
Yeah. So Q3 will definitely be, we're very, at least the start shows that we are not trending on a betterment from last year's Q3. That's all I can say. And definitely it's going to be better, and the software adaptation and the experience is getting better every day. So you can rest assured that good days are around the corner.
Sure. Thanks. Sir, my next question was to Mr. Mahesh. So we are hearing good commentary from our peers, whether it be the hotel industry or airlines with regards to the domestic side. So my assumption is that Thomas Cook would also benefit from the macro tailwind and at least the domestic. So I wanted to get your sense on that. And the second part is the DMS portion of our business is predominantly overseas, right? So if you can highlight the forward bookings there, what kind of growth are we seeing? Because that business was growing at a much faster pace, which has come down in this quarter by a bit. But if you can give some outlook there, would be useful.
So Deepak, let me take both questions in 2 different parts. The first one on the domestic side, as I mentioned, and you would see it in our deck also, our domestic portfolio, despite the challenges, grew. It's not necessarily, the growth rates are not necessarily aligned to our internal targets that we have. So I definitely believe there is more room for us to grow. But the challenges that we saw in the current quarter hopefully will not repeat. The unfortunate incident that happened in Delhi, these kind of events does impact some sentiments of how people will connect and stuff like that. But despite that, I think travel as an ecosystem will continue to grow. GST 2.0, the reforms that were announced, will leave a lot more money on the consumer side of it. I think that should be a good fillip to demand generation going forward. So from that perspective, I believe domestic as an opportunity is going to be important. I must also highlight here that we have chosen 4 or 5 large portfolios where we're going to be present on the domestic market. We can't be relevant in all the markets because we'll be so widely spread that we can't make a meaningful impact. So we've chosen those 4 or 5 destinations where we want to be meaningful, and there are 1 or 2 categories where we want to grow. I think that's the way we are building the portfolio, and we will talk about it as we start building scale and our plans around it. But clearly, domestic is one good opportunity, and we are completely aligned to that opportunity in terms of our growth agenda. Coming to the DMS side of it, you're right. A large portion of our business sits in the overseas market. Mixed bag this quarter. Obviously, the Dubai market, like Ram said, we also have a Middle East market operating there. It's a low season, and obviously, geopolitical impact also came into play. That kind of muted the overall growth. But despite that, if you see the growth, we were growing about 12-16%, which is not a small growth in that sense. From a forward booking perspective, there are some markets which are seeing some headwinds, more specifically the US market, because of the reasons that we all know. But other markets are coming up. At least the Southeast Asian markets are showing up well. Their forward bookings are looking stronger as compared to what we had last year. So I'm hopeful of a better outcome for the full year.
Okay, got it. And so one follow-up for the Forex segment. We've been doing well in the retail side with growing in double digits, but the wholesale part of the business is slightly muted. So if you can highlight on why it is muted and, how is it improving?
Deepak, I would look, I've always maintained that wholesale business is more like a byproduct. It's not necessarily an area of focus because what we are talking about is currency movements here. You're buying from one and selling to the other. And I had spoken about it in the past. RBI came with a directive in terms of how much you can sell and to whom you can sell because there was a lot of currency in circulation. I think this is all driven by the digital push that the regulator is bringing in. So obviously, the strictures that they brought in is to say that to someone whom you are selling the currency note to should sell 75% of the volume that he bought from you to a retail customer and not be doing a resale on it. So these kind of strictures were put into place from October of last year. I think that's the flow-through impact that you're seeing. But clearly, I think, wholesale is a business which will continue because India will still need some cash. Even our retail portfolio, if you see, 35-40% of the people still prefer to take some cash and the balance goes in the form of card. So you will see the cash flowing through in the wholesale market, but that necessarily is not a big business. Our focus has been on the retail side, and the double-digit growth that you are seeing there is a testament of the kind of distribution and the product portfolio that we've created.
Sure. Okay, thanks.
Okay. Thank you, ladies and gentlemen, for your questions. I just want to conclude by saying that this was a difficult quarter. Despite that, I think the Thomas Cook Group has shown resilience in its performance. My expectation is that with the reforms that the government has announced and no untoward or major incidents happening, I am expecting a better outcome in H2 for the industry as a whole. Thank you very much for your question and have a good day.
On behalf of B&K Securities India Private Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.